Welcome to the Salty Investors Christmas edition. It is Friday, December 22nd. It's episode 62. How are you feeling, Tim? You into festive spirit?
Yeah, you sort of got to be a little bit, but um, yeah, went shopping last night. Seemed pretty crowded, so good to see. Retailers doing well a little bit, but I don't know how much everyone's spending. What about yourself?
Oh, I've just noticed, like, down where I live, like the roads are just chock a block full going to the supermarket. Like every idiot has to leave it till 3 days before Christmas to go and get a ham or whatever they're doing. It's just like, Jesus Christ, you had time. There is this thing called the internet. You can order stuff that way and you don't have to go shopping. But I don't know. And you can feel the tension. There's people fighting over
Oh,
car spaces and Christ knows what. It's just, it's horrible. It's just
yep.
horrible.
hmm
Um, Maybe that should have been my salt. I could have ranted on that for ages. Anyway, what do you got for us this week in terms of salt?
CanStar just did a survey of 3,000 Australians and found 28% are expecting an average debt of $825 after the holidays. Half of these people have a credit card, and over 90% of them have existing credit card debt.
Hmm.
25% have already reached their limit on their card, and a quarter said they've increased their limit to account for the Christmas spending. So about 10% of the population are going to have a lean January. You shouldn't be going into debt for
Yeah,
a
yeah,
consumerist Christmas. If things are tight, just cut back a little bit. It's a way better option than
yeah.
going into excessive debt over junk that you're going to have zero long-term benefit. I just can't understand it.
Yeah.
No.
No, I know. I don't know if you saw. Was it a week or two ago? Apparently, some news, some real estate agent sent out a letter. Did you see this to
Oh yeah.
like tenants saying, sort of behave yourself because January is known as eviction month in the real estate industry, because people spend up too much at Christmas and can't afford to pay their rent. I mean, you're a moron if you do that. And of course, the real estate agency got in trouble and had to send out an apology. But they're exactly right. I mean, like, your rent is more important. Like, the place where you live that puts a roof over your head, where you can take a shower and sleep. That's more important than buying, whatever bullshit you're buying for this
Yeah.
overly commercialized, you know, day when the Son of God was supposedly born, even though then we're not even really sure if it was the 25th, and highly doubtful it was the Son of God. It was just some hippie who was a bit of a peacenik. So I mean, this, you know,
Yeah.
sorry to all the Christians out there, but let's face it. Um, it's like just get your priorities straight.
Yep.
I mean,
Yeah, that's right.
there's people online go, oh, but what am I going to tell the kids? Tell the kids you're fucking poor and you can't afford Christmas. That's it. Too bad, kids. Here's a little, whatever. Here's
Yep.
a secondhand figurine that here's my He-Man figures from 1987.
Yeah.
Play with them.
Or take them to the park, or there's a million things you could do. Take them fishing, or it costs you nothing. All these things that you can do that they'll probably value more than buying some cheap, stuff that some kid in China had to build and ship over here and got nothing out of it. Like and they're going to last a couple of
Yeah,
months and it'll be forgotten. It's just
yeah,
hedonistic type treadmill type crap that I'm afraid that we're addicted to. So,
yeah,
mm,
yeah. Well, you and I are just Grinches, aren't we? Grinches.
yeah, I know.
Uh,
You salty about anything
anyway,
this week?
yeah, well, I don't know if it's salt because I found some pleasure in this as well. ANZ had their AGM yesterday and was quite the affair with a bunch of climate crazies interrupting proceedings, dressed as acrobats, complete with red clown noses, which is, very apt because it was a clown show. So they lectured the room on the fact that ANZ lends to those evil fossil fuel companies, the ones that help keep the world turning and keep your lights on, those ones. But eventually they were ejected after about 10 minutes. And the chairman did say, the ANZ chairman did say that, yes, ANZ has a relatively large oil and gas exposure, and that's not something we shy away from. So good on him for saying that. But, the climate catastrophe death cult is at it again, and we should expect more of the same going forward as we edge closer towards, in their minds, climate Armageddon. What do you think, Tim?
Well, like, wish I could disrupt a few meetings as well, and put my Pretty sure that's not allowed, but
Yeah, but
yeah.
you'd be like me. You'd be interrupting meetings, going, "How come you're paying 60% of your earnings as dividends when you should be reinvesting your capital at those high rates of return?" That's what you'd be saying.
Yeah, I still haven't got
Something
those
really boring like
replies.
that. You wouldn't be
May have to
you wouldn't
go
be
to the
wearing a clown
AGMs.
nose.
Yeah, yeah.
Yeah.
But yeah, I don't
Uh,
know. It just seems a bit, I don't know what it's going to achieve. And, I think some of these people are getting their wish. If they stop
yeah.
all this investment, Warren Buffett's hoping all this stuff is going to happen and, investment's going to dry
Mhm.
up and then his stock's just going to multi-bag on everybody. So
Yeah.
um, I think
Yeah.
we're still going to need oil and gas going forward for a few more years yet. Doesn't matter what you think. I think we're still going to, and if you don't invest in it, what happens to price? So I don't know.
Yeah. Well, I keep getting told that renewables are the cheapest out there, and somehow it just doesn't seem to translate when the energy bill comes. Just doesn't, they don't, those two things don't correlate very well.
Yeah,
Anyway,
yeah, yeah.
let's move on. I actually didn't add much this week because because I was out running around buying Christmas presents. No, I wasn't. That's a lie. I could have said that, but it's just bullshit.
You're
Um,
thinking
I
about it.
just Yeah. Um, this chart came from John Hussman's latest missive. Now, I've been saying for weeks, look, just because interest rates start going down and central banks start cutting rates doesn't mean stocks go up. So, often they go down. Uh, of course, Hussman has done the hard work here, and he's delineated between times when they do go up, when interest rate cuts, and when they go down. Now, oh, sorry. Oops. Sorry, people. Um, so this chart has basically got three axes here, so it's a little bit confusing. But you see, S&P deepest loss subsequent 30 months.
Hmm.
So so you can see the ones that were the deepest losses. So you got 2007, you got 2001,
Hmm.
and 1973. That was pretty bad.
Okay.
Market created about 50%. Actually, they all went down about 50%, those markets. Remember, the NASDAQ went down 82% in 2001. Now, what they have in common is um, they had a market cap to GVA in excess of 2, or between 1.5 and 2.5, really high. Market cap to GVA is basically his refined measure of Buffett's market cap to GDP.
Okay.
Okay. It's a little more, it correlates better. It's a little more accurate. That's all it is. So that's the Buffett measure, right? When it's high, when you've got market cap 2 times GDP, it
Hmm.
suggests that the market's overvalued. Now, all of those 3 points where there was obviously a strong interest rate cutting cycle, but the market still traded, had really high uh, market cap to GVAs. Now, the current one where we are right now is that blue line in right over on the right hand side corner.
Oh, okay.
So market cap to GVA has never been higher, right? So if history follows, which it sometimes doesn't, you would expect that an interest rate cutting cycle with valuations this high, or this particular measure this high, which is a reflection of valuations,
Hmm.
would result in the market. Doesn't necessarily have to be halved, but it will go down.
Yeah.
So that's, and so as he says here, I've included the text. Outstanding 12-month returns, shallow 30-month drawdowns. Nearly all of those happy pivot points occurred with a ratio of market cap to GVA below 1.2, right?
Okay.
So this region here,
Hmm.
those. So this here is the subsequent 12-month return. So it's 0.5. So it's a 50% increase. I mean, 1982. Remember what happened in 1982? I mean, the PE started off. We got to a PE on the S&P 500 of about 7, I think, something like that, around 7 or 8. That's what the PE was. So it wasn't. You could only really go one way, and that's when Volcker peaked
Hmm.
his interest rate rises. Um, and yeah, so wonderful returns. Of course, 74 is straight after 73, after you've already had the collapse, and
Yep. Mm-hmm.
you know, so yeah. But anyway, that the point here is that when you've got valuations really high, market cap to GVA or market cap to GDP really high, and you start cutting rates, generally hasn't worked out too well. Um, yeah.
Yeah,
Anyway,
just
um, yeah. So the current multiple is 2.84, right? Out
wow.
here.
Mm-hmm.
I think 2019 is a bit of an outlier because we know what happened there. Yeah, we just before COVID. Um, anyway, moving on. Yeah, just through this in Chapter 11, bankruptcy filings, ratcheting up. Remember, because the consensus is there's basically no landing, Tim. It's S&P
Yep.
6,000 in 2024. Everything's beautiful. The sun is coming up. It's morning in America again. All that good stuff. Um, bankruptcy's going up. Unemployment market is looking worse in the US. I mean, to be honest, relatively, the US looks a lot better than we do.
Yeah.
we we've still got a reserve bank. We've still got our cash rate below inflation,
Mm-hmm.
which is we're just a long way behind. But yeah, so the market's saying rally. It is rallying. We're almost at all-time highs again. Yeah. So did we miss it, Tim? Did we just blow 2023? Did we miss our chance? Is it all over? Should we
Well,
just pack up and go home? Start a
oh,
different podcast?
I just remember '08. Everything was going pretty swimmingly then. Low unemployment. It was all heaps of growth baked into the market.
Yep.
Forward looking, it looked all great as well. So it's just no one can predict these things. It's just you got to be prepared. That's all. And could go one way or the other. We probably should have allocated some. That's what I'm sort of trying to be honest here a little bit. I probably should have
Yeah.
late last year.
Mm.
Should have put a little more capital to work. So I don't know, but it's not looking good. I think you can't just keep papering this over for so long, and interest rates are higher. So I'm happy sitting in T bills. So I don't know. Um,
Mm. Yeah.
at some point we might have to pivot, but we might be pivoting too late. But I'm happy. I'm not too upset.
Yeah. Yeah. All right. Let's move on now. These are Jesus Christ. We covered a few stocks. This is all Tim's work, by the way. Well done, Tim. This is every stock we looked at this year in 2023.
Yep. So yeah, we don't go deep into them, but we just try and have a quick look at them, and I've sort of learned a lot just by doing a quick overview of them. Before you just ignore stuff because you think, oh yeah, I'm smarter than that. I'm not going to invest in this type of area, or I'm not going to be over. Yeah, but there's a whole heap of them that sort of surprised me. A lot of capital intensive stuff like Old Dominion Freight Line, for example. There's a couple there that I thought, oh, I'd never invest in a freight line. That's just lunacy. But once you dig in to see why the metrics are so good, you sort of, you think, oh well, I could see myself at some point in the right cycle, you know, allocating to some of these things.
Yeah.
So sort of wise up a little bit. So I decided to do my top five.
Yep.
So number 5 is Chemomedic, which is basically that cell counting one linked to the
Yep.
FDA. As soon as you start using it, really you're locked in. My number 4 is Market Access. They're the guys that are trying to digitalize the bond market. I think they're great. They've got a few competitors, but just a great market to be in. OTC markets, pink slips, over the counter type stuff. I think that's only going to grow, especially as it's so hard to list. Yeah, just to basically have a monopoly. So just trying to find a right time to get into there. I think that one's not actually too overpriced at the moment for what you get. My number 2 is IDEX. You can never seem to buy one of these things. It's just way too expensive. They do the testing for vets. The vets make a mozza out of it, and they charge it onto customers. Huge margins, nearly impossible to change. But my number one pick is Edward Life Sciences. Um, just the, heart surgery. You're not going to go cheap on that, and they've just got the track record.
Yep.
You're not going to go mucking around with that sort of stuff with a cheap alternative. Doesn't matter how good China gets at it. I just can't see that moat being broken. Um,
Yep.
but impossible to buy. So I had, 10.
But you've given us you've given us a top five, but top five based on what? Just the top five best businesses you think
Yeah, yeah, in the world.
have the best prospects?
Yeah,
Yeah.
I think that is sort of, you know, unknown. You know,
Yeah.
people know Amazon and Google and whatever. So this is ones that I think that people who don't really look outside the
Yeah.
mega cap probably should be looking at a little bit and understand them a little bit. Because at some
Yeah.
point you might actually get a chance to buy them. Um, and,
Yeah.
they can really go
But
up in
then
value. Yeah.
they're not top five in terms of where like you wouldn't be recommending adding them to your portfolio right now, right? Because things like IDEX, you need it to come back quite a bit to
Yeah.
to get into it, right?
Yeah.
Like you said, I think you said market access is actually not too far away. Like, can you give us an idea of how far away from investable these are for you?
Well, I am actually a bit salty about market access. Like about $200, I should have purchased it, but now it's about
Right,
270. So
right,
um, it still looks all right to purchase. But if I was going to pick something today, probably Amazon. If I was forced to allocate,
right.
but that's the cool thing about being a small investor. You're not forced to allocate.
Yeah,
Um, you should be able to pick these things a bit better. And I know it's timing a little bit, but pick them when they're not loved as much. The other one I missed out was Nova North Norvis, the fat drug
yeah,
manufacturer. We saw this at the beginning of the year, and I thought it was too
yeah,
expensive. But I saw a massive runway, and I probably should have just had a nibble, like just because the runway was
mm,
so huge. Um,
yeah,
but
mm,
yeah, the lesson learned, I should be paying up a little bit more for quality this year, but I didn't. Um, but to keep it rational, I've sort of looked into a few other people, and I'm trying to reverse engineer GMO's valuation model. They
right.
don't make it public, so I'm running. If anybody wants to help me, let me know. They use a forward-looking dividend discount model, but obviously they don't use dividends. They're using, I think, free
Yeah,
cash flow. So if
right.
anybody wants to help me out with that, let me know. Um, and hopefully in 2024, I can take a little bit more action.
Yeah,
Um,
yeah.
so, yeah, that's
Well,
about it.
maybe I'll add some regrets. I brought up to you quite some time ago, James Hardy,
Mm-hmm.
that it was quite a resilient business, and I think it got down to about $28 or something. I think it's now north of 50. At $28 on my valuation, it was worth purchasing, and of course, I just got. It's about not sticking to a discipline, and I just got greedy and went, oh, well, it might if it drops to 22.
Yeah.
Yeah,
Uh,
so that one got away, and the business is resilient as hell. And the housing market in the United States has actually held up
mm,
probably better than most people expected. And yeah, they're doing just fine. Another one would be I don't know how many times this year I talked about discretionary retail.
mm,
It's all run now. I mean, they've all sort of run 50%, a lot of them. Um, and I didn't have a dip because the thing is, what I got to get out of the mindset of is, like I can take a nibble. It doesn't mean you're done.
yes.
You can tranche in. You don't
Yeah.
have like it's not like I have to get this transaction exactly right because I'm only doing it one time. Um, and so back at the end of October, and I was looking at Adair's, and it's like it's $1.22, and it's now $1.80 or something like
Mm,
that, and $1.90. I don't know. Like why not just take a few? You don't have to. I mean, if you wanted to buy, say, $10,000 worth, you could just buy five or just buy three or something,
yep.
and if it goes lower, you get another tranche. But it's just that it's this stupid idea that you've got to get it exactly right, which is of course is ludicrous because you never will.
Yes.
And yeah, so I'll put that down as a couple of regrets, I
Yep.
think.
Yeah. Well, It's all part of the learning thing. You need to have some hard lessons, but you don't want to
Yeah.
go in the opposite direction too much. So you've still got to keep your discipline. It's just
Yeah.
you don't want to FOMO now into it and think, oh well, I'm going to catch up for you know the losses. I think that's quite dangerous as well. So yeah, yeah, we'll see. 2024 is not far away.
Yeah. 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 What we've done. Yeah. I think that's a good thing about what we've done. Have a much bigger universe of stocks prospects, to keep an eye on. So
Yep.
that's good news. So what are we finishing the year with? We're gonna look at another Australian company.
Yeah, I think you know this one a little bit.
Yep.
Objective Corporation.
Yeah.
It's mainly a SaaS business that services the government sector. It does other things as well, but that's the main business.
Mm.
Similar to technology we covered a few weeks back, but more tailored to the end user. This is a blessing as it builds very sticky products, but it has high R&D costs because it takes a lot to maintain it. There are
Mhm.
three main business lines. They're contact and process, which is like a CRM, ERP type solution. RegTech, which focus mainly on regulation compliance.
Uh,
Planning and buildings, which streamlines the assessment process. All three are great business lines and highly resilient. Last year, they won a 5-year contract for the New Zealand Firearm Registrar, which will be extremely hard to replace. So I think it's going to be there for 20 years. So when you discount those future cash flows, obviously, it's something that I
mm,
like because I can predict the future. The stock is up 1,300% since 2000 compared to 230% for the S&P 500. But can it continue? Let's look at the fundamentals. Shares are diluting, but only slightly, and not an issue if the growth continues. PE and price to free cash flow are extremely high in the 50s. Return on invested capital is great and constantly in the high 20s. Margins are good, but I think they can definitely lift their operating margin if they can cut back some of that R&D at some stage. Growth is good, and it looks like they can easily sustain 10%. It's got a small dividend, but extremely high payout ratio. Again, they shouldn't be paying a dividend as there's plenty of
mm,
growth in the business, and we don't need to be paying income tax. Thank you, guys. They have heaps of cash to cover short-term debt. If you flip over to the balance sheet and cash flow, you can see they've got an net debt of negative 56 million, which is very nice. Free cash flow has been growing, but it's stagnated over the last few years. Like all quality in Australia, there's a very strong bid, but is it rational? I think a
mm,
growth rate of 10% is fair. So a price to free cash flow is 20 is somewhere I'd be looking, assuming they can keep that growth going forward. Trading at a price to free cash flow of 50, it's more than double my
mm.
buy price.
Ooh.
From 2017 to 2020, it was in the 20s. So it could easily get down there again if you keep it on your watch list. What do you think of this company? I think you know about this company a little bit.
Yeah, yeah, but I mean, I came across it years ago when I did a screen because my screens, I just screen things with return on equity of over 15%, and of
Yeah.
course this one would show up, and I think I had double digit EPS growth,
Yeah.
and so it shows up in the screen. So I didn't look too much, but I was as soon as I saw it, I went, yeah, I know this. So the enemy of this business and what could destroy it is a libertarian government because they come in and get rid of all this regulation, and now your software is obsolete. But this is Australia, and that'll never happen unless Millet becomes some kind of worldwide sensation and brings his country back to the fore. But yeah, I mean, it's got, as I've said to you offline many times, I mean, maybe the silliest thing I never did in my life is, get inside the government somehow because, a government contract because, or, just be a grifter off government largesse
Yep.
because once you're in there, it's hard to dislodge you, isn't it? Uh,
Yep.
and the government is always metastasizing, and they need more and more of this shit. So yeah, I mean, nice moat, I suppose. And yeah, I mean, when you say you say they shouldn't be paying a dividend because they should be reinvesting at these high rates of return. Is there the opportunity to deploy this capital? I
Oh,
mean, are they how much of the government sector do they have? And is
well,
it federal and state or
yeah, yeah. They're in councils, with all their planning type software. They've only in like 20 councils in New Zealand. Like, so they've got like
right?
heaps. I'll just chuck all that at sales and stop diluting me, you pricks. Like, what are you doing here with
Yeah.
you? Stop that. Like, that's
Mm.
not helping anity. So buy
Yeah.
back a little bit if you want to thick and burn a bit of cash if you've got too much
Yeah.
there, but don't send me a dividend. That's terrible.
Do you think they're captured by the just the Australian pay me a dividend with my franking credits? Is it that sort of
Yeah.
stupid?
I don't even look at the stock unless it's paying a dividend. And
Oh
that,
God.
and you just like look at these growth numbers, like they're pretty good and they can
Yeah.
obviously allocate capital like but look at the margins. Like, you know,
No, no, those gross margins are ridiculous. I mean,
yeah.
90%. I mean,
And
it's
so
crazy.
they've got plenty of room here to fix up that operating, margin, which would then just send that EPS number. That could just double. Like
Yeah.
if you just incrementally fix up those op margins and just incrementally get them up into the, low 30s, which I don't think would
Yep.
be too hard. You just have to be a bit more rational with your R&D spend. Um, and like, the next contract they got for this firearms registration thing in New Zealand, why not just double it?
Yeah.
Like, like they're not going to care. They want to run the system. Yeah, they're not going to switch to somebody else. Like, so it's got all this really nice stuff that's in the company. Yeah, and heaps of opportunities to grow. That they into the UK market as well. But they are thinking some stupid stuff like, oh, we're going to go into the US and stuff. Just idiotic stuff like that. But
Right.
I think they should stick to Australia, New Zealand, and UK if they really want to stretch it. But we saw what happened to Technology One. They've been burnt, doing all this sort of crazy stuff
Yep.
going into the US. So they can get a little bit more rational before Technology One and just stick to what they're good at. Wow, this is just going to keep printing cash. But um, yeah, you need to buy at a good price. You can't be buying it at
Mm.
50 times. Like, that's just, um,
Well, 60 basically, isn't it?
yeah.
58.
And the
Yeah,
and the
God.
growth isn't that great. Like 16%. Like I'll
Yeah.
pick I'll pick Visa and MasterCard every day over this. So
Yeah.
um, yeah, it comes back rational. You should probably think about it because
Well,
they've
there
got
you
these.
go. Yeah, keep going.
They've just got these great contracts, like
Mm.
government contracts, like you said. They're just money printers. They don't care about costs so much. They just want a good product that's
Mm.
reliable, recession proof. Like this isn't going to be cyclical. So
Yeah.
um, yeah,
Yeah. Yeah. All right. Well, there you have it again, people. Another quality Australian business that is too bloody expensive. There seems to be a theme here, Tim. It happens quite a bit. Anyway, thanks very much for tuning in this year, all 17 of you. And thanks a lot to Tim because he's brought the goods with the companies this year. It's been really good. And he's given us a lot of content to go over. So thanks very much. And we will see you again in the new year. See you later.